All righty, guys. Well, welcome everybody. Hope you're having a great Thursday, great week. And Jason, I knew today we'd have a lot of guys and gals want to see this one. Tax tips. It just doesn't get a whole lot better than tax tips.
They couldn't wait.
They couldn't wait.
Yep.
They couldn't wait.
Yep.
So we've got our good buddy Andy Thomas here today with us. Andy's been here before a time or two doing helping us on different things that are tax related and financial related. Andy is Jeff and I's accountant, right?
Yeah, try to be, try to keep him out of trouble.
You are doing so far so good. But anyway, he is here today and he's got a lot of ground to cover, but hopefully this will be really, really helpful to y'all. As always, ask questions and we'll maybe hit them as we go, kind of just jump in if we're getting a bunch of them as we go along, and then hit them at the end also. So Andy, it's all you, brother. You are up.
Okay, so just kind of as an introduction for what I do, a lot of tax work for a lot of different clients, and I always think that my job isn't necessarily to save taxes. It's part of the job, but really what I'd like to do with a lot of clients is really increase their wealth is what I'd like to do, not illegally certainly, but in a legal way.
Right.
And so that's kind of a lot of what we're going to talk about today. Has that in mind when we're talking about things. And so I was also trying to think of a lot of the types of questions that I get this is our busy time of year, so we get a lot of different questions related to tax. And one of the questions I get all the time is, what type of entity should I be? And so we're going to talk about entity structure, and there's really 4 options. You'll see there's 5 on this slide here, but there's actually 4, and we'll talk about why an LLC isn't really an entity structure in just a little bit. But the sole proprietor is sort of the fallback when you first start out in business. You're probably going to end up being a sole proprietor. There isn't a whole lot of benefit to being anything else at that point in time. But as business grows, probably going to want to consider a different structure, and the S corporation is probably the entity of choice, and we'll talk about that in a little bit. If you are with another group, you might want to be a partnership. So then you would, if that's the structure you want to have, then that, of course, that would be a partnership is when it's you and somebody else, or maybe there's 3 or 4 people involved in the partnership. And a partnership is really just a combination of 2 sole proprietors or 3 sole proprietors or 4 sole proprietors. You're really kind of taxed in the same method. But if you do have a partnership agreement, it does bring into, or if you have a partnership, it brings into place a lot of complexity, because you're basically you're married to your partner. It's not necessarily your spouse, but you're married to your partner. And you better have some agreements in place to say, particularly it says what happens if one of the partner dies, what happens if one of the partners becomes disabled. What if you have a partner and they're 45 years old and they say, I want out of this, I have another opportunity, or some life-changing event has happened, they want to get out of the business. What happens? What's in your partner agreement that states what happens? And then what happens if you have a partner that wants to retire? I know in our practice, our CPA practice, we have 5 partners, and we have agreements in place that cover every one of these issues. And we've had a partner die, and our agreement worked perfectly. We knew exactly what was going to happen. His spouse knew exactly what was going to happen. We've had several partners retire, and they know exactly what they're going to get when they retire. There's no questions about that.
Let me just stop you. So if somebody out here is in that kind of a business relationship right now, but they don't have these things set up, who would they go to? Would it be their accountant most likely to help them get set up, or is it an attorney, or how did you guys do that?
Well, we did it on our own, but
you're smart.
Well, it's not that, but we deal with this stuff all the time.
Right.
So we did it on our own.
Yeah.
But we also have an attorney that looks over all of our agreements and makes
Yeah.
sure they're enforceable and things like that. So it's a combination.
Yeah.
You know, I think you would probably want to have your CPA firm or CPA maybe be the starting point for what needs to go into that agreement, and get the basics, the outline of what needs to go in there.
Because you're going to need help.
You're going to need help. Yeah, your attorney's going to have to put all in all the wherefores and why not, why that's, and all the legalese that needs to go into an agreement.
Yeah.
So it's a combination of the two.
Okay.
And then there might be, some of the, like when you talk about how much money you're going to get when you retire and things like that. There are some people like to have insurance products in there, like whole life and that kind of thing. So you might even have to have, most of these people maybe already know about all that. And so they would have that in place. But if you don't have a background in life insurance, you might even have to bring in somebody that has an expertise in that as well.
Yeah. Okay.
Okay. Okay. Now, another entity choice is the S corporation, and I suspect a lot of the people listening today would maybe have an S corporation set up. That's really, in our world today, that's the entity of choice. There's with an S corporation, there is the potential to save a large amount of self-employment taxes. And self-employment taxes, when we talk about those are the Medicare and Social Security taxes that we're all obligated to pay. And as opposed to a sole proprietorship or a partnership, if you're an S corporation, you would probably establish a compensation structure such that you are able to avoid paying at least some of those costs. As opposed to a C corporation, an S corporation, there's no double taxation. When you have a C corporation, if that C corporation makes money, let's say it makes $100,000, then that corporation would have to pay about $30,000 in federal and state income taxes. And so you'd have $70,000 left over, and then you would pay a dividend out to the shareholders, and then they've got to pay tax on that dividend. So in a S corporation, you don't mess with that.
Do you see small businesses, many of them set up in C corps anymore?
Not anymore. Not very many. We have some clients that are C corporations, and it's there's some reasons for that. There's some particular reasons that we still are a C corporation, and we'll talk about maybe a couple of those in a minute. But S corp, S corp, S corp.
Yeah.
That's 90% of the time, that's the way to go.
Yeah.
Okay. One of the drawbacks of an S corporation, it's not really a drawback, but one of the compliance things you have to do with being with an S corporation, as opposed to a partnership or a sole proprietor, is you do have to get on the payroll. You do get a paycheck. You do get a W-2 when you're in an S corporation. So your compensation is done in two different ways. When you're an S corp, you get a W-2 for your wages, and then you also, let's say the company makes $100,000 over and above what it makes after paying you a salary, then you have to pay tax on that $100,000 of
It
excess.
passes through to the owner.
It passes through to the owner. It's called a pass-through entity.
Yeah.
Okay, so then we talked briefly about a C corporation. And I do put in here that is the least attractive option. I don't know. I don't really want to talk too much about it because I don't think anybody is going to do that. There are a few benefits that a C corporation has that others don't. So we have a few clients that want to be a C corporation because they get to deduct their long-term disability premiums and the long-term care premiums, but it's pretty rare. That's usually not a big enough incentive to be a C corporation. So we won't talk too much about that.
All right.
Okay, we briefly talked about an LLC in a previous slide, and I get this question all the time: is, hey, I think I need to be an LLC, and you have to explain that an LLC, it's a great way to go to add another layer of legal protection for an individual, but it is not. There is no such thing as an LLC tax return. So if you elect to be an LLC and you're not a partnership, you're the only business owner, then you are what's called a single member LLC. And as a single member LLC, you file on your tax return exactly as though you are a sole proprietorship. There is no difference tax-wise on the filing that you do, and it's treated, everything is treated that way for tax purposes. But you do get a level of protection from somebody suing you. So for example, if something happened for whatever reason, they were suing your business, they can sue, and your assets in that business are subject to being sued, but they can't sue you personally.
Yeah.
Okay. And so a lot of times not necessarily with insurance agents, but a lot of times we will advise clients to set up they might own a rental property or several rental properties. And we will most certainly advise them to put those rental properties in an LLC.
Mm.
And it's a way to protect your wealth from being sued for something that might happen. If somebody slips and falls,
Yeah.
coming in on one of your rental properties, they can't go after you personally, but they can go after that, the assets, that particular assets that are in the LLC. Okay, so then the other question I get often is, we're a partnership and now we'd like to become an LLC, or we're starting a new business. Member A and member B come in and they say, we want to form a partnership. And the very first thing I'd say is, okay, that's fine. But what we need to do is establish an LLC. And actually the default position that the IRS has is that you are taxed as a partnership when you have an LLC with more than one member. Okay, so that's the default position. And then if you want to become an S corporation, then the LLC can elect to become an S corporation. And we do that all the time. We really like that because you're still an LLC, which is taxed as an S corporation. But with that type of structure, you don't have to keep minutes. You don't have to do all the garbage you have to do when you're a corporation.
And which so many small businesses neglect to do that anyway.
Right. They don't do it anyway.
They're not up to up to snuff on that.
Right. And you still get all the protection, all the legal protections. So I really advocate if you're an LLC, to have that LLC elect to be taxed as an S corporation. That's really a good way to go. Okay.
So I have a question. So if you want to become an S corp, is it based on income level, or is there some other factor?
Yeah, what
you can
triggers
make
that?
decision?
Two factors, Jason. One is, yes, the income factor, because once you reach a certain point, let's say, I would say 100,000, just to throw a number out there, you would want to, let's say the entity itself makes $100,000 and you expect next year I'm going to make $150,000. Okay. So if you become an S corporation and after talking with your advisors and so on and so forth, you say that, well, I think $70,000 is an appropriate level of compensation for my W-2 that I'm going to get.
Right.
Next year, the business itself is going to make 150,000.
Right.
Okay. I'm going to take 70,000 out as compensation on a W-2 form. And then the other $80,000 is going to be, you're going to pay income tax on that, just like you always have, but you don't have to pay the 15% self-employment tax. Okay.
Yeah.
So the income level is one thing. The other thing is, if you're an S corporation, you do get a lot of legal liability protection, unlike a sole proprietor. Okay. Much like an LLC, you get the legal protection. And the other thing is that one of the things that you have to be careful of when you're an S corporation, there's a lot of temptation to say, well, I'm not going to take any salary. I'm not going to pay any self-employment tax. And then in this example, I'm just going to show the entire $150,000 as income from my S corporation without taking any salary. And then I can completely avoid having to pay the self-employment tax. Well, the IRS can smell a rat.
That doesn't look right.
They know that that's an issue, and people are trying to get away with that. And so within the rules, they talk about reasonable compensation. And so that's where you've got to kind of meet with somebody to figure out, what can we get? I shouldn't say it this way. What can we get away with as far as what is reasonable compensation?
Right.
So
right.
that's an issue you have to be careful with on an S corporation.
Yeah.
Okay, does that make sense, Jason?
Yeah, that's pretty subjective, that amount. You
It's
come up
very
with. I mean,
subjective.
it's not like it's a formula or anything like that.
There's no
It's like,
formula.
you know,
Mhm.
you could say 30,000 and maybe that would be,
So what I usually do is say, okay, like, let's say I'm working with a physician,
yeah,
a family doctor, let's say.
okay,
And I say, okay, Mr. Family Doctor, what's the average compensation that a family doc would get?
yeah,
And he says, yeah, $200,000.
okay,
But he's got a really good practice and he's
Right.
making $400,000.
Okay.
Okay, so we can get away with 200.
yeah,
Okay.
right,
I've also, this is nothing official, but also kind of known out in there in our world is that if you at least pay the Social Security limit, you're never going to have a problem.
oh,
that.
which is,
And
what is that? What's the-
147,000.
So if you're there,
Yeah,
then you're never gonna, it's not gonna go under scrutiny.
right,
Nothing looks goofy.
right.
They
That's
paid the
kinda-
max.
They paid the max on
Right.
Social Security.
Right, right,
The max on Medicare is unlimited. You know,
Yeah.
if you make $1 million, you got to pay, 2.9% on
Okay.
on Medicare.
yeah,
Okay,
okay.
so those are
You
some
just would not
guidelines.
guess that tax stuff could be this fun and interesting, huh? God, that's good stuff.
It's good. I can tell you're excited.
Oh, it's
Yeah,
good.
yeah, yeah.
All right, we better keep rolling here.
Okay. Okay, next we're going to talk, these are some breaks that you get in as far as depreciation goes. So we're going to talk about section 179 and something called bonus depreciation. So with insurance agents, what this is, this allows you to write off in 1 year expense in 1 year equipment purchases. So if you're a manufacturer, you're going to be buying equipment all the time,
Right.
right? You get to write that off. If you're in the grain elevator business, you're always buying a new dryer or putting up a new grain bin, things like that. You can write that all off in 1 year. Now,
Okay.
there's some limitations on that, but we're not going to get into that because it's way up here. If you're an insurance agent, there's nothing to write off, right? You can write off your desk, you can write off your laptop computer,
Yeah,
maybe some software. The only thing that is a possibility really of any significance would be a vehicle.
okay,
Okay. And we get this question, again, I'm kind of drawing on questions that we get all the time.
sure,
Okay, so go out and you buy a new vehicle. You say, I'm going to write this. And if the vehicle weighs more than 6,000 pounds, if it's a pickup truck, usually a
Right.
pickup truck or a larger SUV, the GVW, which you look on the driver's side door panel,
okay,
and it tells you what the GVW, the gross vehicle weight
okay.
is.
It's gotta weigh more than $6,000.
If it weighs more than 6,000 pounds, then you are eligible to take section 179 or bonus depreciation. There's a distinction there, but I'm not going to get into that. It's really the same thing. Okay. So you can take, if you pay $50,000 for your new SUV.
And it doesn't have to be new, does it?
No, it doesn't have to
Doesn't
be
be new.
No, it doesn't have to be new.
Okay,
But you pay $50,000 for that SUV,
yeah,
you can expense the whole thing in 1 year instead of writing it off over 5 years.
right,
So it's a timing difference, okay? Now, that's assuming that you use it 100% for business purposes.
okay,
So, if you drive back and forth to the office, that's commuting, that's not business.
Yeah.
Okay, that's personal use. And in the insurance world now, especially with the Medicare supplements, I suspect that there's not nearly as much travel going out and seeing customers as there used to be.
probably not as much, but there's still
quite a bit.
quite a bit, but not
Okay.
as much. Yeah, I'd say
Okay.
so.
So on your contemporaneous auto log that you keep,
Contemporaneous.
contemporaneous,
that's a big word.
that's a big word, that you keep,
Yeah, oh, yeah,
you've got a list the who, what, where, why, and when
right.
that you see,
Mhm.
and all those miles, you keep track of them.
Right.
They add up to 80% business use.
Of the total, you're good.
Yeah, so now your $50,000 that you spent on your SUV, you can write off 40,000 of it, 80%.
Mhm. Okay,
Okay. But
that's a big write-off.
it can be a big deal. But again, I want to emphasize it's timing. You get it all this year
Oh, this year, what happens
instead
in
of doing it over 5 years.
what happens in it 2 years later?
Mhm.
You trade that vehicle in and you get a different one. Now what happens?
You get start over.
You start over.
Mhm.
And do you get a new 5 years, or you get to, instead of spreading it out over 5 years, you get
You
take
get
the
to
net
start off-
all off in the first year?
Yeah, but, so let's say you trade it in
Yeah,
and you get 30,000 on the trade-in.
right,
You have to show that 30,000 as income.
okay,
And then let's say you got a new one for 60,000.
so you get a $30,000,
Yeah, you got to
You
do
get
the
30,000.
difference. Yeah.
yeah.
And why does the weight matter? Like how does that apply to electric vehicles? You know, the batteries are real heavy.
Mhm.
Is that a different set of rules?
No, it's the same. It's 6,000 pounds, no matter what type of vehicle. it
Andy
is.
made me do that a few years ago.
By, no, your partner.
You did it. And I went out and bought a big expensive, I bought that big Lincoln.
Yeah,
I would never buy that car,
yeah,
but I did.
yeah,
I did it in December
did.
too.
yeah.
Yeah, because he said, you guys need to do this to
Yeah.
get some write-offs, and so
Yeah.
we did.
Yeah.
Because
But
normally I drive them till they got 250,000 miles on them,
I'm the same way. So
Anyway.
cheap accountant, but
Maybe you guys know about that, but that's really a good little, it's not a trick, it's there, but
yeah, it's in your bag of tricks. you
yeah,
know,
but it's gotta
so,
be over 6,000 pounds.
Yeah,
Isn't there a list they can go to, like you can Google something?
you can Google it on, just Google, gross vehicle weight, 6,000 pounds, and it'll give you a list of vehicles that qualify. And Jason, answer your question. I have the 6,000 pounds, somebody probably lobby group in Washington DC came out, it's purely arbitrary. There's no rhyme or reason to it. Yeah.
Yeah.
You can't just fill the trunk with weight. Yeah, it has to stay on the.
Right, it's got to say it on there. Yeah, yeah. So. And, really, and then the other thing, while we're talking about vehicles, is I don't want to buy a SUV, I don't want to buy a pickup truck. I really like to get some kind of Mercedes. I'm not a car person. A Mercedes convertible that costs 120,000, let's say. You really need to think about leasing it. And especially if you use it a lot for business, and it's a little bit above the scope of going into this, but talk to your CPA about why it's advantageous to lease what we would call a really fancy luxury car.
Really?
Yeah. Yeah. There are some pretty good advantages to doing that.
Okay.
Okay.
But the business use still applies though, right?
Yeah, you still got to have business use. Yeah, absolutely.
Yeah. Contemporaneously.
Contemporaneous. Keep that auto log, write it down.
All right.
Okay, all right.
Moving.
So as I stated in the beginning, one of the things that we try to do is help clients build their wealth, and a lot of the way you can do that, especially if you own your own business, is through the different retirement plan options that are out there. And there's really some pretty generous options that people need to think about. And this can happen at different stages of your life. It's really difficult when you're starting out, and if you're a fairly young person, to put away a bunch of money for retirement when you've got a big mortgage to pay and you've got kids you got to save for college, or maybe they're in college, and you've got some pretty good obligations. But there are some really nice retirement plan vehicles that self-employed people can use to help save for retirement even later in life. And so some of the ones we're going to talk about are the Simplified Employee Pension, which is the SEP. And then there's a Simple IRA. And then there's a lot of different things you can do with the 401k plan. And then we're also going to talk about Secure Act 2.0, which is a new law that was just passed here recently. I think it was either December or January, probably December, and which really does a lot. There's a lot of good stuff in there for retirement planning. Okay. So a simplified employee pension. Maybe a lot of you are familiar with this. If you have a business where you don't have any employees, it's just you.
Mm-hmm.
To give you an example, we do a lot of these with farmers.
Right.
In our practice, there's a lot of farmers.
We'd have a lot of people on here like this, that there's individuals,
Mhm.
There's nobody else in their
Right.
business.
And so you can do, depending on how much money you make, if your compensation is $305,000, you can do $61,000 into a SEP plan. I just had a farmer client in this morning, and he's 63 or 4 years old.
Yeah.
And, for those of you that don't know much about ag down here in central Illinois, every farmer in the world made a ton of money this year. They had great yields and prices were fantastic. It's
Yeah.
just a perfect good storm
Yeah.
this year. This guy made, he's a small farmer, he made over $400,000.
Mhm.
And so we've talked about, why don't you pay yourself $61,000 into
Mhm.
your set plan,
Mhm.
and then you get this $61,000 deduction. It's
Yeah.
going to save you at least, 18, 20,000 in tax.
Exactly.
And, and then you can take it out later on when you're in a much lower tax bracket.
Right.
Okay.
To win.
It's a win-win. And so, so the maximum you can do is 61,000, and next year it's going to be, what's that, $66,000 next year. Okay.
Mhm.
And the way this is calculated is they'll tell you in the literature, if you look at it, it says you can do 25% of your compensation. But as with the IRS, nothing is that simple.
Mhm.
So it's you can do $25,000 after you subtract out the contribution. Okay, so and the math just works out that it's 20%.
Mm.
Okay, so for example, if you made $100,000 times 20%
Right.
is 20,000.
Right.
100,000 minus 20,000 is 80,000. 80,000 times
25% thing.
is 20,000.
Right.
So that's how we get there. The IRS makes everything too complicated. So anyway, just 20% is what you need to keep. in mind. Okay. Now, if you have, the bad part about a SEP is if you have employees, then you've got to contribute the same percentage that you contribute for yourself. You can contribute up to 20%.
Okay.
But whatever you contribute, you've got to contribute that same percentage for your employees.
Mm-hmm.
Now, you don't have to do that until you can do it right away if you want to. But if you want to say, I don't want to have to pay that guy until I absolutely have to, then it would be in their third year. They have to work for you.
3 years.
Yeah.
Mm.
Yeah. 3 out of the last 5 years, which means
Mm.
year 3. Okay. So it's much easier for somebody to become eligible for a retirement plan than it is in a 401k plan where you have a vesting
that's a
schedule.
really great point for individuals there.
Yeah. Yeah.
And you're really creating wealth.
Mhm.
Yeah, that's great.
So we primarily our advice usually is for clients, if they make a decent amount of income and they want to contribute to the SEP and they're by themselves, they don't have any employees, the SEP's a good way to go. It's very simple. It's not what we would call a qualified plan where you got to file with the IRS or anything. It's very simple. Okay.
All right.
Okay. Another one is very simple. It's called a simple IRA. And so again, this is not a qualified plan. We don't have to do any filings with the IRS to do a simple IRA. You just have to download a form, fill out some things, and stick it in a drawer. You don't have to send it to the IRS or anything to adopt this plan. And so what you can do is you can do 14,000 annually into the plan as long as you've made at least 14,000. You got to have earned income to do that. If you're over age 50, they have a catch-up contribution where you can do $17,000. You can do an additional 3,000. And
I got a question.
Yeah.
Can you do both the SEP and the simple IRA?
No,
Can't do them both.
No, can't do both.
Okay.
Okay. So and then you get a matching of 3% of compensation, and you have to do this for, you do it for both yourself as the person that's employed or owns the business, and you'd have to do it for any of your employees.
Mm-hmm.
Now the formula for that is, let's say I'm an employee and I make $50,000 a year, and I contribute $1,500 of my own money into the SEP plan, then the employer has to match that $1,500
In the SEP or the IRA?
in the SEP or in the simple IRA.
Okay, you're right.
This is simple IRA. So
Right.
now let's say I make $50,000 and I say, I don't want to contribute any of my own money into the plan. Then the employer doesn't have to match anything.
Okay.
The most they would have to match in this example was $1,500.
Okay.
Okay. So that's option one. The other option is that there is no match. And you just say, I'm just going to contribute 2% to everybody, regardless of whether they put any of their own money
Mm-hmm.
into the plan. Okay. What I like to do with particularly people that might be just starting out in business, but want a retirement plan, this is a great stepping stone before you might want to go with a 401k plan.
Yeah.
It's very simple. You get with your broker to put the money into the plan. You put it in, and then let's say you have a business where you make $100,000. So you can, and you're under 50 years old, so you can put the 14,000 in. Then you have the 3% match, so you can do another 3,000 into the plan. And so you can put $17,000 away. And if your spouse happens to work in the business as well, you can do you can do
the same
14 with her, or I should say her, with the spouse. And then you also get the 3%, which probably isn't going to be, that spouse probably isn't going to be making 100,000 if you're making 100, but there might be a small amount that goes in for that. So as a family unit, you can put well over $30,000 away into the simple IRA if you have both people on the payroll.
Good.
And that's a lot of money. I mean, you can really build up a lot of cash if you start early enough.
Right. Yeah. We got a bunch of questions. Do we want to hit any of these right yet, or are you winding down or winding up here, Andy? You got a bunch more to go, or
how much longer do you want? I can do whatever we need.
why don't we answer some of these questions and see where we're at?
Okay, with a single member LLC electing to be an S corp, does one need to have a payroll company do the payroll for one member? Any recommendation of payroll service company for a single member?
You do have to have payroll, and you can, I'll tell you what we do. We do a lot of payrolls for people. So you might check with your CPA firm to see if they do it. And what we do to keep the cost down is, let's say we've kind of established what this is going to be and what the amount of compensation is going to be. And then we train this person to make the deposits with the IRS every 2 weeks, so that all they have to do is go in and click a few buttons and send payroll tax withholdings to the government. And it's the same amount every 2 weeks because we've established a salary for them. Okay. And then at the end of the year, they need us to do their W-2 for them. And that's about it. And there's some payroll. Well, I should back up. Every quarter they have to file payroll tax returns, and we do that for them. And then at the end of the year, we do a W-2 for them. So, but you can get paychecks, ADP. I think if it's just you might check with your CPA firm to see if they can do the payrolls for you. It might be a little less expensive than going with one of the big dogs. So,
okay. Hope that helped.
Lucas asks, can you repeat the wage number or reasonable salary minimum under an S corp?
Okay. Yeah, that's kind of industry specific. I can't give you an exact number because it depends on what industry you might be in. Like I gave the example of a physician, so if you were a CPA, it might be, I don't know what it would be, but I think what he's asking about is the wage base. It was $147,000.
Yeah.
Is that, Jason? Do you think
that puts you over the maximum, up to the maximum for your
security?
Or was that when we were talking about how to decide if you need to jump from an LLC to an S corp? I'm not sure.
Oh, okay. Okay. I see what you're saying. Yeah, that could be too. I would say that probably, I would say if your compensation gets into that $60,000-$70,000 range, I would say then it might be time to consider being an S corporation.
Okay.
Okay.
Angie wants to know if we'll get a copy of these slides. Yes, Angie, we're going to send out a recording, and we'll try to include the slides in that as well. And then I think we have why don't we move on, and then we'll circle back to some of these.
Okay.
401k plan is, I think most people are probably familiar with that, but that again, you have to be on, you'd have salary. That is money that comes out of your paycheck. And so the amounts that you can defer out of your own paycheck are $20,500 in 2022. If you're over age 50, they give you what they call a catch-up contribution of $6,500. So then you could do 27,000. And then starting in 23, those numbers jump from 22.5 to 30,000. So you can see you can put away I'd mentioned earlier that the simple IRA is a stepping stone to a 401k plan. And so a 401k plan, you can put away quite a bit more if you're to that point where you really want to defer more money. The drawback of a 401k plan is it's what we call a qualified plan. That means that somebody has to write a plan for you, whether it be somebody that specializes in this. We happen to write plans for this, not trying to sell anybody anything, but just there are CPA firms out there that do this. Or you can actually, if it's just, you can actually, I think we have a few clients that I think they went to Vanguard, and Vanguard, I think, wrote a plan for them. So some of the
So
brokerage
like you put
firms,
your money, your contributions with them,
Them,
and
yeah,
they take
yeah,
care of the
yeah,
setting it up for you.
right. And what we do primarily, or what we recommend now, there used to be all kinds of 401 different ways to structure a 401k plan. A few years ago, the IRS came out with what they called a safe harbor 401k. And this is by far and away the choice most people make when they are adopting a 401k plan, because basically you can do, if you adopt this, there's all kinds of testing that has to be done in a 401k plan so that highly compensated people aren't getting the bulk of the money. You know, they want to make sure the employees are getting taken care of. So there's top heavy rules. It's all kinds of stuff it's beyond the scope of this. So what the IRS came along and said a few years ago says, look, if you will just put in 3% for your employees, regardless of whether they put any of their own money in or not, then don't worry about all these rules.
Yeah,
Okay.
that's what we did.
Yeah.
Yeah.
And so you can either do that, the 3% rule, or you can say we'll put in 4% of anybody that puts in any of their own money. So there's two different ways you could meet this safe harbor.
I see.
Okay. So the second one, the 4%, I probably didn't explain that very well. So again, an example, I make $50,000. I put in 10,000 of my own money. 50,000 times 4% is $2,000. My employer's got to put in $2,000 on top of the 10 that I put in. I make $50,000. I don't put any money in. Employer doesn't have to do anything.
I see.
Okay.
Yeah. Whereas in the other, the flat 3, he's contributing 3,
He's contributing
no matter
3 for everybody, whether-
chip in or not.
Exactly.
Employee chips in.
Yeah. Okay. Then there's something called a solo 401k. And these are a great deal for exactly what it says. If you're a solo, you don't have any employees, you're on your own. Okay.
Right.
You can put in, I should back up on the 401k. You can also attach a profit sharing plan to the 401k. So let's say, well, I really want to do 5% for my employees. Well, you can attach a profit sharing plan that adds another 2% onto the 3% that you're going to do for them. So that's always an option.
Okay.
Okay. The solo 401k again is for individuals that don't have, really it's for, this doesn't have to be true, but nobody does this unless they have no employees.
Right.
Okay.
My boy has this.
Yeah.
Joe.
Yeah. Okay. No employees. You can put away a ton of money, and you got to have, as long as you have about 225, 230 in compensation, you can put away the maximum dollar amounts that are shown here on this slide, 61,000 this year in 2022 and 66,000 in 2023. So just kind of be aware of that. It's a really good deal if you're on your own.
Yeah.
Okay. And you can get to those levels on the SEP, you could almost get those levels, but you had to have a lot higher compensation level.
Right.
Okay, Secure Act, this is what we were talking about earlier that came out, and don't want to get into it too much, except that it really makes Roth IRAs more attractive. And for those that don't know what a Roth is, basically you can put money into a retirement vehicle, whether it's a Roth 401k, a Roth IRA, and you don't get any kind of a tax benefit when you do that. There's no immediate tax benefit, but you get that money grows tax-free for the entire time it is in a Roth IRA. And then when you take the money out, you don't pay any tax on it. Okay, so the Roths are a great deal. And what this Secure Act 2.0 did, before, if you had a simple IRA, You were not allowed to do a Roth under the Secure Act. You are now allowed to do Roth money with the simple IRA. And I think we're probably running out of time a little bit, but yeah, it does. But if you want to look at the Secure Act, there's a lot of attractive pieces to that. Okay, health savings accounts. These are the best deal ever. It's
You sound like a salesman.
I know. And we guys do, but we don't. It's just like having a tax deductible Roth IRA. So a lot of people that are sole proprietors or S corporation owners have to go out and buy their own insurance and health insurance. And we know how expensive that is. So you probably have a high deductible plan.
Right.
And if you have a high deductible plan, then you're eligible to do a health savings account. And the way this works is you can put, and I'm going to forget what the thresholds are. I think it's $7,300 this year. You can put $7,300 if you're on a family type deal into a Roth, a health savings account. You get to deduct that $7,300 on your tax return. Okay. And you put it in an account. You can even put it in a stock account. That's gonna make money. You don't have to put it in a 1% interest account.
Right.
And then you put that money in there, and you can let that grow. You can put this money in every year and let it grow tax-free. And then you can use that money to take medical expenses out now if you want to. But you don't have to. You can pay those expenses out of your own pocket, and that money will continue to grow and grow and grow. And then when you're 65, 66 years old, you want to retire, you're going to have a pot full of money that you can use for medical expenses. And here's the other beauty of the thing is picture a big box.
Right.
You can put all those receipts that you paid out of pocket from the day you started this plan, you put them in that box, and 20 years from now, you can reimburse yourself for those expenses.
That you pay personally?
That you pay personally.
You're kidding me.
No, you can pay those expenses out of your HSA account.
And they could be 20 years old.
Yep.
Does anybody do that?
I've encouraged a lot of people to do that.
I didn't know that. I didn't know that was doable. I've got this. I don't have very much money in mine. I mean, a few years ago, I had a high deductible and I put some money into it. It just sits there. I never use it because I just pay it myself. But I didn't know that I could reimburse myself on down the road if I chose to.
Yeah. It's a great deal. It's a great deal.
We run into customers who have big amounts in their health savings accounts. Like they might have 100,000 in their health savings account, and now they're on Medicare. And so they can use, they can use that if they do go, let's say they buy a Med Advantage, they can use that to pay their co-pays and their out-of-pocket maxes, that are not being reimbursed, or other non-reimbursed medical costs, so they're like set for life.
And they can pay their Medicare premiums.
I didn't know that you could do that.
You can't pay the other types.
You can't pay your Med Sup premiums with it, can you?
I don't think.
No, I don't think you can.
Just Medicare premiums.
When you say Medicare premiums, you're talking about your Part B premium that's normally taken out of your Social Security?
Yep.
Didn't know that.
Yep.
Really?
You can't take.
How do you do that if you normally have it just taken out of your Social Security when that goes live?
You can tell the Social Security you don't want to.
They bill me?
Just say bill me. You can
and then you pay it out of this thing.
Yeah, or you can reimburse yourself out of the.
Didn't know that.
Nugget for the day.
There you go. Probably a lot of people on this call knew that. Okay, we better keep going. This thing is. You're hot, Andy, but we got to roll here. Yeah.
Okay. These will be quick. Okay. So one of the things that happened with the tax bill in 2018, as everybody knows, was they increased the standard deduction. If you're married, it's now up to $27,000. So a lot of people no longer itemize deductions because the standard deduction is so much higher. You get the higher of your standard deduction of 27,000. Or your itemized deductions. Okay. And so your itemized deductions are made up of interest you pay on your home mortgage, state and local taxes, which are your income taxes, state income taxes, and real estate taxes to pay on your house. Those are limited to $10,000. That's it. Doesn't matter how much you spend. It's $10,000. medical expenses, but not hardly anybody has those unless you got somebody in a nursing home. And then charitable contributions. So here's a typical example we see all the time. Somebody typically, let's say they give $10,000 a year to the church, let's say.
Okay.
So, and they have their real estate taxes, state income taxes are limited to 10,
Right.
and their home mortgage interest is 6,000.
Okay.
So they got a total of 26,000, right? Of
Yeah.
itemized deductions.
Right.
They don't,
They may as well take the standard
they
deduction.
take standard deduction.
Right.
So the question we get, so, it's just like, it says, I'm not gonna quit giving money to the
Right,
church,
right.
but I'm not getting any tax benefit for it.
Right.
What can I do?
Uh-huh.
So one idea, if you have the wherewithal, let's say you got some money sitting around,
Mhm.
you can donate $50,000 in this example, $50,000 to a charitable, a donor fund.
Mhm.
Places like Fidelity have this, the Community Foundation in Decatur has this.
Okay.
And you tell them, you give them the 50,000 and you tell them, and you get a $50,000 deduction that year
Mhm.
as a charitable donation.
Mhm.
And you tell them, I want you to give $10,000 a year for the next 5 years to my church.
Mhm.
Okay. So you're front loading your you're front loading it. The church is going to get the same 10,000 that they're
Right.
always going to get.
Right.
It's going to come from, they probably need to know it's coming from you, really coming from you, because the check's going to come from the foundation.
Huh.
Okay.
Interesting.
And so then at least you get the advantage of this.
I didn't
Excellent.
realize that real estate taxes, the most you can take off is 10 grand.
That's it. Yeah.
My gosh.
That's it. Yeah. So the donor advised funds is if you have the wherewithal to do it, that's a good way to
Okay.
maybe to at least get 1 year where you get a $50,000 deduction
Yeah.
plus the 10 plus,
Yeah.
so, but you got to have the money to be able to do it.
Right.
Okay.
Okay.
Okay. Then there's another thing that we get quite a bit is if somebody is reached their what we call required minimum distribution
Right.
age, which is
72 and a half now.
well, for this, it's now 73, but for this purpose, it's 70 and a half.
Okay.
So
All
go
right.
figure.
Okay.
So you can, instead of giving, so let's say you're same situation, you're not able to itemize your deductions
Okay.
and your required minimum distribution, well, no matter what it is, let's say it's $8,000 a year. That's
Okay.
how much you have to take
Okay.
out of your retirement money.
Yeah.
Instead of doing that, you just have the money go directly out of your retirement account to the charitable organization.
Okay.
And then you don't have to pay tax on that $8,000.
Right.
You don't get
You don't get to spend it either.
you don't get the charitable deduction for it, but you're not going to get it anyway, right?
Mhm.
Because you're doing the standard deduction. So you save having to pay tax on $8,000 in that example.
Mhm.
Okay, so if you talk to your CPA or your tax preparer about it, just use the words QCD. Okay, we do everything in acronyms, so so they'll know what that is.
All right. What do we got, Jason?
Okay, we have several questions here. Okay, Diane says, I'm a sole proprietor and have a large SUV that I use for 2 businesses, insurance agent and rental property management. Would I still be able to take that vehicle deduction? I can easily meet the 50% business usage together, but not both separately.
Okay, so what you do is you would allocate, I don't know, let's say it's 50-50 between the business and the rental properties. And this is a little bit tricky. This is going to be a little bit tricky because remember the slide, it had section 179 and bonus depreciation on there. So Diane can do the section one. Let's say that's a $50,000 vehicle and she uses it 100% for business use between the two things. So she would, on her depreciation schedule, she would put 1/2 Suburban, $25,000 and take 100% she could take section 179 on that. For rental properties, you can't use section 179.
You didn't tell us that, Andy.
I know, sorry. But you can use bonus.
Okay.
So on the other one, she would put 1/2 suburban on her, because there's a different schedule.
Okay.
There's a Schedule C for her business and there's a Schedule E for her rental properties. There's two different schedules.
Okay.
And so then she just needs to split it.
These guys got such, what do we call it, like security, or nobody's gonna know that stuff.
I know, it's so crazy, but the
Job
answer is,
security.
yeah, she could do it on both schedules. She'd have to do it, she'd have to split it.
Okay, Mike asks, can I still set up a simple IRA for 2022?
No,
Okay,
you have to establish it, I believe, by October 31. So in other words, he would have had to have established it by October 31 of 2022.
okay, can you have your kids as employees and have a solo 401k?
If you would write, in that situation, you would write the plan to make sure that eligibility starts at age 21. Oh, so they're saying they want to have the kids in there. Is that right?
I'm not sure.
Okay.
That's not clear.
If you want to keep the kids out, you make the eligibility age 21.
Okay.
If you want them in, then you don't have an age requirement. But if you have employees down the road,
You're gonna have to match it.
you gotta put them in there. Yeah.
So as far as employees go, your own family doesn't count toward that solo
No,
requirement.
you gotta do what you gotta do. See, the way a solo works is
It's just for one, right?
you can do it for multiple people. But the problem with it is that you have to do the same percentage that you're doing for yourself. So if I'm doing a solo 401k, I've put in, the way it works is the contribution, there's a profit sharing element to it. And that's 20% of your compensation. Okay. So if you have a child that makes $10,000, you've got to put $2,000 into the plan
Okay.
for them. Okay.
Okay, we have one. If you have the $225,000 compensation to get a max savings for the 401k, that means you have to pay more on self-employment and get more savings through retirement plan. So it's a trade-off.
Well, if you've got more than 225,000 of compensation, you're going to have to pay self-employment tax regardless of whether you contribute to the 401k or not. Okay. So you're not really out anything. And the question is correct. You do not get to deduct the amount that you put into the solo. You can't deduct it for self-employment tax purposes. Okay. So the premise of the question is correct, that you do not save any money on self-employment tax by putting the money in the 401k plan. It's strictly, you only save the income taxes on it.
Okay.
Okay.
All right, if a company uses a 401k, but I guess the question is, can they change to a simple IRA?
Yes, you would have to do your 401k, you would have to terminate the plan. The big disadvantage when you terminate a plan is if you have any employees, they become 100% vested when you terminate. Okay. But you can terminate that plan and everybody gets their money out of the plan, owners and employees, and they typically would roll that to an IRA account. And then you can start the next year, then you could start off with a simple IRA.
Okay. All right, and I discovered IRAs and SEP in 1992, and if you're very disciplined and you pay yourself first, you can build a very, very nice nest egg. Try to save 50% of my income. In 98, discovered what Roth IRAs, excellent saving vehicle.
Mhm.
So,
And I'll be calling you later for a small business loan.
okay, Mike, if I rent my home that I live in and work out of a home office in that home, can I deduct part of the rent as an office rent?
Say it again.
If I rent my home that I live in and work out of a home office in that same home, can I deduct part of the rent as office
So he's
rent?
saying he's got a home office. He rents
Mhm.
his house. Can he still deduct?
Oh, he rents this out. Well,
Can he deduct part of his, get a deduction for that home office?
well, if anytime you have a home, anytime you work out of a home office, if he does not have anywhere else to go and he's works strictly out of his home office, then yes, you can take a deduction for home office expense, regardless of whether it's
Whether you own it or you rent it.
right.
What's-
If he's staying there.
What is it? Is it this percentage of square footage, or how do you do that?
Okay, so a couple, oh gosh, it's been longer than that. About 5 years ago, the IRS came out with, they call it a safe harbor. And if your home office is 300 square feet or more, you automatically can deduct $1,500 off your return.
Okay.
Okay, that's one option. The other option is to actually measure what your square footage is and compare that to the square footage of the entire house and let's say that percentage is 10%.
Okay.
Then you can take 10% of your real estate taxes, mortgage interest, utilities, house insurance, water bill, all that stuff.
Okay.
So.
I need to move my home office out of the spare bedroom and into the basement.
And
Exactly.
and that's the other thing is, Jason, I'm glad you said that, because according to the rules, okay, that space has to be used exclusively for your business
Yeah.
purposes, okay?
Yeah, I hear you.
Not that an IRS agent's gonna,
Gray on that one.
yeah, there might be a little gray there.
Yeah.
Yeah.
Okay.
Uh,
All right.
yeah,
Is that it?
And just as good info, learned a couple of new things I can use for myself. Yeah, I had a question. So if we have an agent who is selling insurance part-time, but they have a full-time job elsewhere, do all these rules still apply, or?
Yeah, they can,
So
in
they can-
fact, if they have a 401k plan or something at their regular job and they make enough money that they want to contribute to a SEP, yep, you can do it. So,
Okay.
yeah.
Sweet.
Yeah.
All right.
All right. Well, Andy, thank you, brother.
Okay, thanks.
Really,
Jeff.
really
Yeah,
appreciate
no
it.
problem. Okay.
Everybody, thank you so much. Hope that helped a little bit. And we'll see you soon. Have a great rest of your day.